Welcome to the Deep Dive. We get straight to what you need to know.
That's the plan.
And today we're looking into wealth management and that whole issue of financial inequality. It comes up a lot.
It really does.
So you're here to get a good handle on how wealth gets built and, the things that feed into those financial gaps we see. No fluff, just the core ideas. Okay, let's jump in.
Sounds good. We've got some pretty interesting sources lined up. First, an article from Old National Bank. It's got wealth management tips specifically for entrepreneurs.
Okay.
Then there's one from Caliber. That one goes into different ways you can build wealth using real estate. Lots of options there.
Real estate, always a big one.
Definitely. And finally, we're going to dig into a pretty lively Reddit discussion. People are talking about why it feels like the rich keep getting richer, while others are struggling.
The Reddit perspective. Always interesting. So the mission here is to pull out the key insights, right? Strategies for entrepreneurs, what's happening in real estate, and those bigger societal things affecting our finances.
Exactly. We want practical takeaways and hopefully some food for thought.
What's cool is how these different angles, business, property, societal discussion, they actually connect. They give a fuller picture.
Yeah, they really do. Let's start with the entrepreneurs. That Old National Bank article, it kicks off with a pretty big number. Something like 88% of millionaires are self-made, often through their own business.
88%. Wow. That really says something about building your own thing.
It does. So the article gives 5 key tips for managing wealth if you're an entrepreneur. First up, diversification. Getting money out of just the business.
Makes sense. Don't put all your eggs in one basket.
Precisely. Todd Villarubia from Wealth Planning Law Group is quoted there. He points out, so many entrepreneurs have nearly everything tied up in their company.
Right. You reinvest, you grow, but that's risky.
Super risky. Think about, the article mentions a pandemic, right? Something totally unexpected can hit hard.
Yeah, absolutely.
So diversifying into stocks, bonds, real estate, it's a safety net. And, maybe think about assets that aren't correlated. Things that don't all go down at the same time.
Like if the economy dips, maybe commodities hold up better than stocks and real estate.
Something like that. It's about buffering against different kinds of shocks.
Okay, solid advice. Tip number 2 is cash flow management. Sounds basic, but I bet it's tough for entrepreneurs. Income can be all over the place.
Exactly. Charmaine Green-Ford in the article really stresses knowing where you stand. Assets, liabilities, income, expenses, the whole picture.
You need that clear view.
You do. And Villarubia adds some practical stuff. Keep personal and business money separate. That's huge.
Oh, yeah.
Build an emergency fund. Use forecasting tools. And Maiko Sakai had a neat point. Apply for credit when you don't need it.
Really? Why is that?
To get better terms, build up your business credit rating. So when you do need it, you're set up. It's about being proactive.
That's smart. Build the foundation before the storm hits.
Mm-hmm.
Okay, third tip, retirement planning. The article mentioned a SCORE report. Over a third of entrepreneurs have no retirement savings.
Yeah, it's pretty concerning. They don't have that company 401k, right?
Employer match.
Nope. So Villarubia says you have to treat yourself like an employee. Set up your own plan. The article even mentions some advanced stuff like cash balance plans or using life insurance tax efficiently.
Okay, so not just the basic IRA. I need some expert advice there.
Definitely, especially for those more complex strategies. It really highlights that need for specialized planning.
Right. Okay, fourth tip, succession planning. Thinking about the future of the business. Seems like maybe that's for later, when you're bigger.
The article argues you should think about it early. I mean, retirement, disability, even death. What happens to the business?
Good point.
Villarubia mentions grooming a successor, maybe setting up buy-sell agreements if you have partners, or just planning to sell it eventually. And this ties into your overall estate plan, wills, trusts, making sure everything goes where you want it to.
Protecting the legacy, basically.
Yeah.
And your family.
Exactly. It's about looking beyond just the day-to-day operations.
Makes sense. And the last one, tip 5, is asset protection. This feels critical given the risks of running a business.
Absolutely critical. Entrepreneurs just face more legal and financial risk. So, again, keeping personal and business finances separate is key.
That firewall.
Right, and having the right insurance. Protecting your personal assets if the business gets sued or runs into trouble, it's fundamental.
Okay, so that Old National Bank piece gives a really solid playbook for entrepreneurs managing their wealth. Let's switch gears now to the second source. Caliber, talking about real estate.
Yeah, they frame it as this historically consistent wealth builder, why it limited land, growing demand, simple economics, really.
And they gave that stat about U.S. home prices, up over 200% since 2000.
Yeah, a pretty stark illustration of that long-term appreciation potential.
So how do you actually invest? Caliber listed 7 ways. What's the first?
Private equity funds. Basically, you pool money with others to buy into bigger commercial properties.
Okay.
They break it down by risk. You've got core or core plus lower risk focused on income, then value add renovating properties for potentially higher returns, and opportunistic. That's like ground up development, highest risk, highest potential reward.
Different flavors for different appetites.
Exactly. And they specifically mention qualified opportunity zones or QOZs within that private equity space.
Right. Those came from the 2017 tax law. Sounds like
Yeah.
special tax breaks.
Potentially big ones. If you invest capital gains into projects in these designated underserved areas, you might defer taxes on those gains until late 2026.
Okay, deferral is nice.
And get this, if you hold that investment for at least 10 years, the appreciation on that investment could be completely tax-free.
Wow. Okay. But there's a catch, right?
Yeah, Caliber notes it's mostly for accredited investors. You need a high-risk tolerance, a long time horizon, and the rules and timelines are really strict.
Got it. Not for everyone. What's next? REITs. Real estate investment trusts.
Yep. REITs. Think of them like mutual funds, but for real estate. They own or run properties that generate income.
And they have to pay out dividends, right?
Right. They have to invest most of their assets in real estate and distribute, I think it's 90% plus of their taxable income as dividends.
Okay. And there are different kinds.
2 main types mentioned: publicly traded and non-traded. Public ones trade on stock exchanges, so they're easy to buy and sell liquid, but their prices can swing with the stock market.
Like that drop in 2008 they mentioned.
Exactly. Non-traded REITs aren't on exchanges, so much harder to sell quickly. They're illiquid for a few years usually, but their value is tied more closely to the actual property values, and they might offer higher dividends, maybe better for steady income if you don't need quick access to the cash.
Interesting trade-off. Liquidity versus potentially smoother income. Okay, method 4. The 1031 exchange, that's the one with the history about farmers swapping land.
That's the one, a like-kind exchange. It lets you sell an investment property and roll the proceeds into a similar one, equal or greater value, without paying capital gains tax now. You defer it.
Indefinitely.
Potentially. And then when you pass away, your heirs might get it with a step-up in basis, which can wipe out that deferred tax liability.
Powerful. But sounds complicated.
Caliber does say the rules are complex. Lots of requirements, timelines. Need to do it right.
Definitely need advice there. Okay, 5th is syndicates, like that Empire State Building example.
Yeah, pooling money from lots of investors who become limited partners. They get passive income. Someone else manages the property. It lets you into bigger deals.
Access to larger projects. Makes sense. What's number 6? Mini IPOs.
Or Regulation A+M. Thanks to the JOBS Act, private companies, including real estate ones, can raise money up to $50 million from the general public, not just the wealthy accredited investors.
Oh, interesting. Opens it up more.
It does, but Caliber warns these are often early-stage companies. Significant risk involved. Due diligence is crucial.
Buyer beware, as always. And the last one, number 7.
Private debt funds. Instead of buying equity, you're pooling money to lend for real estate projects. So you're the bank, essentially.
Ah, okay. So getting interest payments back.
Right. Might appeal if you want income, maybe a shorter time horizon, and potentially less risk than equity.
So, wow, lots of ways into real estate. Different risks, different rewards. Okay, let's shift to the third piece, that Reddit discussion. The whole rich get richer, poor get poorer thing.
Yeah, this brings in a whole different vibe. It really echoes that K-shaped recovery idea you hear about. Some people's assets are growing, others are feeling squeezed.
What were the big themes coming out of that Reddit thread?
Compound interest was huge, just massive. That Einstein quote, he who understands it earns it.
He who doesn't pays it.
Yeah. Loads of users were sharing how starting early, even small amounts, just grows exponentially over time. Like Ragu 455, Sala Wanderer, they were all about that long game.
But then you got the pushback, right? People saying, great theory, but I can't even save $100 a month.
Exactly. Users like, I don't care, 111, AF Nord, they highlighted the reality check. High cost of living, especially rent, just makes saving impossible for so many. That was a really strong counterpoint.
The struggle is real, basically.
It really is. Then there was this idea that user, just that carrot, called it money loves money. Once you have a little saved, it changes your mindset.
Like it creates momentum.
Yeah, maybe a positive feedback loop. Another user, Jay Bang 2, said even seeing tiny interest payments made them think differently about spending, but getting over that initial hump, having any capital to start compounding, that seems to be the biggest hurdle.
That initial barrier. The thread also mentioned the job market, like
Yeah.
underemployment, gig economy stuff.
Yeah, echoing what Forbes said too. College grads not finding jobs that use their degree, gig work not offering much advancement. It limits long-term financial security for a lot of people.
And inflation came up too, that hidden tax.
Definitely. People feeling like their money just doesn't go as far, especially hitting lower and middle incomes harder because more of their budget is essentials.
There was a debate too, wasn't there? About whether anyone can become a millionaire just by saving consistently.
Oh, yeah. Puzzle-headed Yam7582 posted some numbers like save X amount for Y years.
And people jumped on that.
Lots of skepticism, like easy to say, hard to do. It really showed the gap between, spreadsheet calculations and lived reality.
Yeah, theory versus practice. What else stood out from Reddit?
A lot to talk about family background, opportunities you inherit or lack, the difference between making money from capital appreciating versus just earning interest. Combat made that point.
Right, that investing is different from just parking cash in a savings account.
And that the really wealthy often reinvest heavily, start businesses. They don't just live off interest. That was Combat again, and others.
What about debt? Any discussion on that?
Yes. Slurpee Sandwich made a great distinction. Using debt strategically, like leverage for a business good, potentially.
Yeah.
Using debt for consumption, buying stuff you don't need bad, a huge drain.
Good debt versus bad debt. Classic.
Absolutely key. There is also skepticism about relying on fixed percentage returns for retirement. Because of inflation, market crashes.
Things aren't that predictable.
Right. Combatant brought up the safe withdrawal rate concept, which is a more nuanced way to think about drawing down savings in retirement.
Okay. And that boot paradox. Being poor is expensive.
Yeah, Expletive Little shared that. Buying cheap boots that wear out fast costs more in the long run than buying one good pair. It illustrates how lacking funds can force bad financial choices.
That's a powerful analogy. Financial literacy came up too, I assume.
Oh, definitely. Proper somewhere 571, others. Stressing how important it is to understand money basics. But then you also had users like, just me, saying the whole system is tilted towards the wealthy.
The systemic argument.
Yeah. Rice Rocket Writer argued interest itself isn't the issue, it's how it's used or how the system works around it. It got into some fundamental questions about fairness.
Complex stuff. But despite the disagreements, was there any common ground?
Yeah, I'd say a general agreement on the power of compound interest long-term. Broccoli of Doom, Imaginary Swing, 4370 were big on that. Also, the need for delayed gratification and having valuable skills. Avalon 34 mentioned that.
So discipline and earning potential.
Pretty much. Oh, and avoiding bad debt was a recurring theme, too.
Yeah.
Acanthisi Upbeat 638. Others hammered that home.
Got it. So a really wide-ranging discussion on Reddit, touching on personal habits, systemic issues, the whole shebang.
Absolutely. From individual choices to government policy impacts, even religious views on interest. A real mix.
Okay, so let's try and tie this all together. We started with the Old National Bank article. Really practical advice for entrepreneurs. Diversify, manage cash flow, plan for retirement and succession, protect your assets. Crucial stuff if you're building wealth that way.
Right, very focused on that self-made path, which is a big part of the wealth story.
Then the Caliber article showed us the sheer variety of ways to invest in real estate. From funds and REITs, which might be more accessible, to more complex things like 1031 exchanges or QOZs, catering to different goals and risk levels.
Yeah, highlighting real estate as a major, multifaceted wealth-building engine.
And finally, that Reddit discussion just threw open the doors on the bigger picture. The immense power of compounding, yes, but also the huge hurdles many face just getting started. Cost of living, lack of capital.
And the importance of financial literacy, the good debt, bad debt debate, plus those tougher questions about whether the system itself creates these disparities. It really brought in the human element, the struggles and different viewpoints.
So it's a mix of strategy, opportunity, individual action, and these larger economic forces all interacting.
Exactly. It's not just one thing.
Which leads us to the final thought for you, the listener. Thinking about all this, the strategies, the opportunities, the challenges, the systemic stuff, what's the most impactful step you can take starting today? What move can you make to build a more secure financial future and navigate this complex world of wealth?
It's a big question. Maybe it involves looking at your own spending and saving habits. Maybe it's seeking out more knowledge. Maybe it's thinking about long-term goals versus short-term wants.
Something to really reflect on. Consider your choices, their ripples. Where can you make a difference for yourself?
Good place to leave it. Lots to chew on.